Joining us right now on the market impact of today's inflation data, especially in light of the rise in bond yields that we've seen in recent days, we want to bring in Savita Subramanian. She is the head of U.S. equity and quantitative strategy at BofA's Securities. And first of all, okay, this number is the most important number of today. Could tomorrow's CPI number change everything?
I mean, I definitely think it could. I think that, I'm surprised by the softness in this number, to be honest, because I thought that there would be maybe a mini restocking cycle. If, companies are worried about tariffs, they might actually pull forward a lot of buying. So I am surprised by this softer number. Look, I think we're in an environment where there is a risk that inflation comes back. And I agree with the idea that tips don't really tell you much about the future. Tips are one of the worst indicators of actual inflation. They tell you what just happened rather than what's about to happen. So I think we're in a murky territory here. I mean, look, we took all Fed cuts off the table. The idea is we're not going to see any cuts this year. Our economists are basically of the opinion that we don't get to the numbers that we need to see in terms of, our star, in terms of like actual inflationary measures coming down to levels that the Fed would be comfortable with. I think we could see a bit of a reflation cycle in the first half of this year. So, look, December, that just happened. What about the future? I think that where we are right now is an environment where you've got a lot of reasons to think that unit volume sales and demand picks up again. One is this restocking cycle based on pulling forward demand ahead of uncertainty around tariffs. Two, you've got an administration in place that is basically much more likely to dial back regulations, which I think will actually increase rates to the upside. I mean, historically, what we've seen is that regulation has been a big driver of productivity, or deregulation has been a big driver of productivity gains, and productivity gains are correlated with higher, not lower interest rates. So, again, when I look at this, I think we're in a complicated setup. It's not a foregone conclusion that the Fed is going to continue to cut from here.
So you look at this as temporary relief at best. What would it take for you to start to think, okay, maybe inflation isn't starting to heat back up?
Yeah, I mean, I think you need to see January. Retail sales has been strong. I think holiday demand, according to our credit card data and some of the early reads, was actually quite healthy. So I think the consumer was spending pretty aggressively last year. I think CPI holding up higher and PPI dropping is actually great for corporate margins, if you think about it. I mean, we used to have this indicator called the corporate misery indicator. And, I mean, we still have it. And basically what it does is it gauges the spread between prices, pricing power, and unit volume and input costs. And that drop in PPI and a steady CPI would actually be good for margins, because it means that companies are able to price, but their actual input costs are going down. So I think this might be a better scenario for margins than it is for the consumer. I think that the consumer is in a tenuous position, because right now we're at a point where real wage growth is positive. So that's great for consumption. That's great for feeling like you can spend more at the grocery store. You can spend more on stuff if you're making more money than prices are going up. But I don't know if it actually feels that way. And it really depends on where you sit. If you're sitting in New York, it doesn't feel like wages are going up and prices are going down. In fact, it feels the opposite. So, I think the consumer is in a tenuous position. We need to really see how they navigate this.
Okay, so we watched the S&P futures jump on this. It put us back above 5,900 at the open. If we continue here, 5,902 is where we're sitting. For the end of the year, I think your price target is 6,666. Easy to remember number.
That's my easy to remember number. And I think that we're going to see a good year for stocks. Not a great year, but not a bad year. But I do think that the idea that the market is going to climb higher because interest rates are contained is not necessarily the case.
So interest rates are going to go higher and the market's going to climb despite that, because of some positive influences and because corporate margins are going to be able to be maintained.
And margins, exactly. And I think that we're also in an environment where deregulation, productivity, those are the stories we should be focusing on rather than just what is the Fed going to do over the next 3 months or 6 months. I think the Fed is relevant, but maybe too focused on in this environment where we've actually seen margins hold up remarkably well, despite the fact that we've seen rampant inflation volatility. I think that's a testament to the fact that companies are spending on productivity. They're getting more efficient. Our analysts are seeing that trend continue. Maybe AI helps, maybe it doesn't, but this trend is in place, and I think that's what we need to be more bullish about rather than just our 10-year yield's going to hit 5% or are they not going to hit 5%? Why is 5% the magic number at which everything goes off a cliff?
Well, the only thing I'll say is at 5%, it looks like a much more attractive place to put your money. And maybe it lures in institutional buyers. Maybe it lures in and it becomes a counter place to put your money.
Sure. And what I would say to that, Becky, I think they're already there. When you look at allocations to stocks versus bonds, stock allocations are actually not at those fever pitch levels that you would think, okay, it's time to get out. In fact, based on our sell-side indicator, allocations to stocks are around 56, 57% on average. Not super high. Like back in the 2000, they were at 70%. Back in 2007, they were at,
much higher levels. Which is why every time you get a 5% pullback, you see money rushing back in.
Exactly.
Right. You're not going to stick to a 5, and we watched that this morning. If you didn't put your money in, you missed your 5% pullback already.
Exactly. That's right. That's exactly right. Great point. And I think that that's the environment we're in. We're in an environment where long bond rates are probably going to move higher, but I don't think we should freak out about that from an equity investor's perspective. Rates can move higher because of growth, because of productivity, because of all sorts of good things, and they can move higher because of, disorderly shocks to the rates curve. I think as long as it's a gradual incline, which is what we've seen so far, it can be okay. But I would watch the consumer because I think that inflation is getting tricky and harder to navigate. The good news is we have an administration in place that's probably going to lower the cost of oil and gas and heat, and I think that will be a good salvation.